So my background is I've worked for over 30 years in professional services and financial services. I've spent approximately a third of that overseas, with about 8 years in New York and 3 years in Hong Kong. Debenture has two distinct but complementary parts. Practically, I spend most of my time running the professional services business.
I'm the joint portfolio manager. I've worked alongside James Hennison managing the portfolio since 2011, and then I became joint portfolio manager in August 2019.
The investment objectives of the investment trust are to achieve long-term capital gains and steadily increasing income in real terms. What we look to do is outperform the FTSE All-Share, and I'm delighted to say that over 1 year, 3 years, 5, 10 and 25 years, we've done precisely that.
The key differentiation of Debenture versus the UK equity income peer group is the combination of the IPS business, the independent professional services business, and the portfolio. The IPS business is roughly 20% of the trust's net asset value, but most importantly, it provides a third of the overall income for the trust. Now, what that means from a portfolio management perspective is that we have greater investment flexibility. We can go across the market and buy zero yielding shares if we want to, if we think that's the best total return opportunity. So they might be recovery shares, the likes of Marks and Spencer's. They might be early stage growth companies, the likes of Ceres Power. But those would be very difficult to buy within the context of a traditional UK equity income fund. Now, from an investment process perspective, what we're looking for is market leading companies, or companies that could be market leading in the future. They're high quality, they're growing, very importantly, they're growing sales, growing earnings, but we have a strong value discipline. We're looking to buy companies at the point at which they're overlooked for some reason. It could be all sorts of different reasons, but they're being overlooked and therefore they're undervalued. So it's that strong value discipline and, very importantly, the ability to look across the breadth of the UK market and sometimes overseas. So over the last 1, 3 and 5 years, the trust has outperformed its benchmark, which is the FTSE All-Share. If I drive into the reasons for that, and I'll try and group it into 3 distinct reasons. The first is that we can buy those zero or low yielding shares. If you look on a 5-year view, the best performers there would be the likes of Ceres Power, the likes of Flutter Entertainment. We can also, and it's sort of two sides of the same coin, but we can avoid the higher yielding shares that have underperformed. For example, we have no British American tobacco. We have no tobacco at all, in fact, in this fund. And that has been one of the top contributors to performance, not having that relative to the benchmark over the last 5 years. So that's 2 contributors. The third is that ability to go overseas, particularly to the US market. So over a long-term time perspective, say 5 years, among the best performers has been the holdings in the likes of Applied Materials and Microsoft. We don't own those shares anymore, but both of those have been among the top contributors. Very importantly, we always focus on growing the capital. It's our view that if you grow the capital base of the portfolio, the income will follow from that. That has worked well for the trust over the long term. This is a trust that has at least maintained, normally grown its dividend for over 40 years. And on a shorter term time horizon, over the last 5 years, this is the trust that has grown its income at the fastest rate within the AIC UK equity income sector. Clearly, the backdrop is very uncertain. We've got both geopolitical and economic uncertainty. That being said, you've always got to return to valuations. And where we are now, the portfolio is on a PE that's priced to earnings of roughly 9 times. Now, importantly, that's on a 12-month historic basis. So there can be no debate about what that earnings figure is. It's already happened. That 9 times would be considerably lower than, say, a 5-year, 10-year average for the portfolio. So yes, there's uncertainty, but you could argue that that 9 times PE is already considerably, to a good degree, reflecting that uncertainty. History would suggest that if you buy at a lower valuation, you have a better prospect for your long-run total return. So if you're willing to look through the uncertainty, be patient, history would suggest that valuations are important and valuations are low at the moment.
In the professional services businesses, perhaps we could just look backwards in order to look forwards. The last 5 years has thrown a variety of economic conditions at us. and we've also had COVID. We've had high inflation, periods of low inflation, and throughout that period, we've got a diversified portfolio of businesses within the IPS businesses that have allowed us to hit our target of mid to high single-digit growth in profits each of those 5 years. If 2020 teaches us anything, it's the value of forecasting can be somewhat limited. But even with all the economic uncertainty, we are very focused on listening to our clients and responding to the needs of our clients and investing in our people and our skills in order that we deliver excellent outcomes for our clients every day.